Welcome back to the Wall Street Podcast. Today, we're diving into Citi Research's latest report, Global Macro Strategy Views and Trade Ideas, Back to School, How to Navigate September Headwinds. This was published September 4th, 2025. It's quite comprehensive, covers NFP implications, market seasonality, Fed policy, even tariffs.
Indeed, and our focus today is really on those tactical recommendations and the assumptions beneath them.
Exactly. Are Citi's conclusions, fully robust, or do they perhaps understate some key market risks? I'll be arguing for the strength of Citi's framework presented in the report.
And I'll be looking closely at those interpretations, highlighting where the data might suggest alternative views or perhaps a bit more caution.
Okay, let's begin with the non-farm payrolls, the NFP, and the labor market outlook. Citi suggests that the recent big NFP revisions downwards probably won't be followed by more negatives unless we see clear recession signs, which, they argue, aren't there yet. Now, they do expect pretty significant downward benchmark revisions, about 400,000. The question is, does this view adequately capture the underlying softness, or could these revisions actually point to something more precarious, especially if unemployment ticks up towards, say, 4.4 or 4.5%?
Well, I think Citi's perspective might be understating the material risk here. Yes, current asset prices don't scream recession right now, but the sheer size of those expected downward preliminary benchmark revisions, the ones for April 24 to March 2025, due September 9th, that's significant. And look, historically, it's quite rare for an initially positive NFP print to turn negative on the second revision. So even if a negative print doesn't immediately signal recession, it certainly points to a, perhaps, deeper underlying softness than initially meets the eye, regardless of what the August print itself shows. It warrants, I believe, a greater degree of caution.
Okay. Let's shift to September market seasonality. The report clearly highlights historical headwinds for equities, specifically the S&P 500. And tactical indicators like Bitcoin's performance also suggest negativity for the NASDAQ 100, the NDX. Now, bonds also show negative September seasonals, but Citi believes tightening liquidity and an anticipated dovish Fed cycle mean the equity seasonals will likely dominate, providing support for bonds heading into the FOMC meeting.
Right, I see the point on equities. But the simultaneous negative September seasonals for both equities and bonds, that's historically quite rare, isn't it? Usually you only see that pattern in periods of really high inflation, or conversely, very aggressive FOMC easing. So, given where we are now, are we truly convinced bonds will stay resilient, especially after the FOMC meeting? What if we get a shallower easing cycle than the market's currently pricing in? That could challenge the whole idea that bonds will hold up even if equities falter.
That's a fair point on the historical rarity, but Citi's framework does try to address this. They argue that the current drivers, specifically tightening liquidity combined with the expectation of a dovish Fed cycle, create a unique situation. This specific mix, they contend, will support bonds into the meeting, allowing those equity seasonals, like for the SPX, to play out more distinctly this time. It's less about history repeating exactly and more about, the specific forces at play right now.
Okay. Now let's talk Fed policy bias. Citi points to what they term excessive dovishness priced into the Fed's reaction function. They say it's partly justified by the softer labor market, sure, but significantly amplified by what they call reconfiguration risks. You see this apparently in the decoupling between the one-year OIS pricing, that's the market's bet on the Fed rate a year out for the following year, and the 5-year break-evens, which reflect medium-term inflation expectations. So the market prices a lower terminal rate even as inflation expectations remain higher. The report suggests this unusual policy bias is structurally bullish for U.S. equities. Do you buy that?
Structurally bullish? I'm not so sure it's healthy, even if it is bullish in the short term. I mean, look at the broader macro picture right now. You've got high and actually rising 5-year break-evens, equities are rallying. These conditions don't typically scream for such extreme dovishness from the Fed based on fundamentals alone. So yes, it implies the market is leaning very heavily on this additional force, these reconfiguration risks like the February 2026 deadline for regional Fed chairs. It seems weighted over pure economic fundamentals. To me, That suggests less of a structural support and more of a potential disconnect, making any bullishness feel perhaps more fragile.
Okay, so wrapping this up, Citi's report gives us a detailed framework for navigating September. It emphasizes this interplay of potential NFP revisions, the known seasonal headwinds, those unique Fed policy dynamics we just discussed, and even the ongoing tariff uncertainties, which persist despite legal challenges.
And while we clearly have some differing interpretations, particularly around the NFP revision risks and maybe the resilience of bonds post-FOMC, engaging with these multiple viewpoints is, I think, essential.
Absolutely. And you can see how these dynamics affect everyday life, right? Big NFP revisions, they can shift how people feel about job security almost overnight. September volatility, that obviously hits retirement accounts.
Exactly. And the Fed's decisions directly impact borrowing costs. Think mortgages, business loans. Even those tariff situations, however they play out legally, end up influencing the price of goods we buy every day, affecting household budgets.
So a rigorous, nuanced look at these factors is really crucial for any sound investment analysis. There's certainly a lot to consider in this report.